For most of the past decade, markets moved in a familiar rhythm. Stocks climbed when growth looked strong. Bonds rallied when growth slowed. Gold and silver drifted quietly in the background, responding mostly to interest rates and currency shifts. The system felt predictable. When risk appetite was healthy, money flowed into equities. When caution rose, investors hid in government debt. Metals were often an afterthought. But that rhythm is no longer holding. Gold and silver are climbing sharply at the same time. Equity markets are wobbling, and bond markets are flashing subtle signs of strain. This is not the usual pattern. In stable periods, rising real interest rates tend to pressure metals. A strong currency often keeps gold contained. Yet now, even with restrictive monetary policy still in place, metals are breaking higher. That contrast is the signal. Gold is not simply another asset class. It functions as a stress barometer. It responds not just to inflation or rate cuts, but to confidence. When participants begin to question the durability of financial plumbing, the pipes that move money through banks, funding markets, and sovereign debt, gold tends to move before the stress becomes obvious in headlines. Look carefully at the backdrop. Banking stress indicators are quietly rising. Regional lenders are facing tighter funding conditions. Deposit competition has intensified. Unrealized losses on bond portfolios remain sensitive to rate volatility. None of this is front-page panic. But beneath the surface, funding is more fragile than it appears. At the same time, credit spreads are widening. Not dramatically, but steadily. Corporate borrowers are paying more to issue debt relative to government bonds. That widening is a subtle warning. It suggests lenders are demanding greater compensation for risk. In calm periods, spreads compress as confidence grows. When they widen during tightening cycles, it often reflects caution spreading through the system. Liquidity is also thinning in key funding markets. Bid-ask spreads have grown less forgiving. Treasury market depth has not fully recovered from past shocks. Repo markets, which form the backbone of short-term funding, show signs of strain during moments of volatility. These are not dramatic failures. They are early tremors, and gold is responding. Historically, metals have often moved before the narrative catches up. In past cycles, gold turned higher months before rate cuts arrived. It rallied before banking stress became official. It climbed before currency regimes shifted. Not because traders predicted headlines, but because they sensed pressure building in the architecture of money itself. That is why this moment deserves attention. When metals rise alongside tightening financial conditions, it breaks the usual playbook. Normally, restrictive policy strengthens the currency and dampens gold. If gold is climbing anyway, it suggests something deeper than inflation fears. It hints at concern about stability. Now consider the number quietly circulating in some macro circles: $5,500 gold. This is not a forecast. It is not a promise. It is a scenario, a theoretical repricing level that would reflect significant currency adjustment or systemic strain. To reach such levels, it would require more than speculative enthusiasm. It would imply a meaningful shift in how markets value fiat money relative to hard assets. The key point is not the number itself. The key point is what kind of environment would justify it. Markets rarely send clear signals all at once. Instead, they whisper, first through widening spreads, then through subtle funding stress, then through asset classes that move out of sequence. Today, gold and silver appear to be speaking in that quiet language. Meanwhile, equity investors remain focused on earnings forecasts and artificial intelligence optimism. Bond traders debate the timing of rate cuts. The headlines emphasize surface-level volatility. But underneath, the structure of liquidity is adjusting. In stable times, markets reward leverage and confidence. In uncertain times, they reward resilience. Gold's rise suggests that some participants are quietly repositioning toward resilience. The question is not whether metals can continue higher in the short term. The deeper question is what they are responding to. Are they anticipating easier monetary policy? Or are they reacting to stress in the system that policymakers have not yet fully addressed? Because if gold is signaling strain, then something fundamental has shifted beneath the surface of global finance. And that leads to the critical question: what exactly changed in the system to trigger this break from the normal rules? If gold is signaling strain, then we need to ask which rule has been broken. For decades, the relationship was simple. When interest rates rise sharply, gold usually struggles. Higher real yields increase the opportunity cost of holding a non-yielding asset. When the dollar strengthens, metals often soften because they are priced globally in dollars. Tight money tends to pressure gold. Easy money tends to support it. That was the playbook, but today, that rule is bending. We have seen one of the most aggressive tightening cycles in modern history. Policy rates moved from near zero to restrictive levels in a short period of time. Real yields turned positive. The dollar strengthened. Under normal conditions, that combination should have capped gold's upside. Yet metals are holding firm and, in many cases, breaking higher. That contradiction is the signal. To understand why it matters, we need to revisit how tightening cycles usually unfold. Central banks raise rates to slow inflation. Credit becomes more expensive. Growth cools. Risk assets struggle. Eventually, something in the system breaks off in a leveraged sector that depended on cheap funding. At that point, policymakers pivot. Liquidity returns. Gold rallies in anticipation of easier money. But this time, metals are not waiting for the official pivot. They are moving while policy remains restrictive. That suggests the market is not focused solely on rates. It is focused on durability. Can the system withstand prolonged, tight conditions without triggering instability? That is the deeper question. History shows that markets rarely fracture because inflation rises. They fracture when liquidity disappears. Inflation can be managed. Liquidity crises are harder to contain because they involve competence. When lenders begin to doubt borrowers, and when counterparties begin to question each other's balance sheets, the plumbing tightens rapidly. This brings us to the core mental model: confidence versus liquidity. Confidence is belief that the system will function tomorrow as it did today. Liquidity is the ability to access funding when needed. When confidence weakens, liquidity thins. And when liquidity thins, stress spreads faster than expected. Now, consider recent central bank behavior. Officially, the message remains firm. Inflation must be controlled. Policy must stay restrictive. Rates will remain higher for longer if necessary. Yet behind the scenes, we see something more complex. Emergency lending facilities have been introduced during moments of banking stress. Balance sheets, which were supposed to shrink under quantitative tightening, have occasionally expanded during episodes of strain. Swap lines between central banks remain active to stabilize global dollar funding. These are not dramatic reversals. They are quiet backstops. In other words, restraint in public, support in private. When central banks say they are tightening, but simultaneously create tools to inject liquidity if needed, it reveals tension. They are walking a narrow path between controlling inflation and preventing financial instability. The tighter they hold policy, the more fragile certain parts of the system become. The more they support those fragile areas, the harder it becomes to fully contain inflationary pressure. Gold appears to be responding to that tension. If markets believed tightening could continue indefinitely without side effects, metals would likely remain subdued. But if participants suspect that sustained restriction will eventually force intervention, they begin positioning early. Gold becomes less about inflation hedging and more about policy credibility. This is why metals holding strength under high real rates is significant. It hints at skepticism, not panic, not collapse, but skepticism about whether the current stance can persist without consequence. Credit spreads widening quietly reinforce this message. Subtle funding pressures echo it. None of these indicators alone confirm systemic breakdown. Together, they suggest that liquidity is not as abundant as it once was. And when liquidity becomes uncertain, markets start repricing risk in advance. So the broken rule is not simply that gold is rising during tightening. The broken rule is that confidence in uninterrupted policy control may be fading at the margins. Which leads to the next layer of the story. If liquidity is the real battlefield, then we have to ask a harder question. Where exactly inside the system is that pressure building? If liquidity is the battlefield, then we need to look beyond screens and bond yields. Because pressure inside the financial system rarely begins in isolation. It often reflects shifts in the real economy, in production, energy, and power. The deeper story is not just about interest rates. It is about control. Gold and silver are traded in futures markets and ETFs, but at their core, they are physical metals. They must be mined, refined, transported, and stored. That physical chain matters more than most investors realize. When supply chains tighten, financial pricing adjusts. Start with mining concentration. A significant portion of global gold production comes from a relatively small group of countries. The same is true for silver, which is often produced as a byproduct of copper, lead, and zinc mining. This creates geographic clustering. When political risk rises in key regions, supply risk rises with it. Mining is also capital-intensive and slow to expand. New projects can take a decade or more to move from discovery to production. Environmental regulations, permitting delays, and community opposition add friction. In stable periods, this slow pipeline is manageable. In unstable periods, it becomes a constraint. Energy costs add another layer. Mining requires heavy machinery, diesel fuel, electricity, and complex logistics. When energy prices rise, extraction costs climb. Even if spot prices for metals remain stable, producers face margin pressure. Over time, higher input costs push the equilibrium price higher. This is not speculation. It is arithmetic. Now place that into a world of geopolitical fragmentation. Trade corridors are no longer assumed to be permanent. Shipping routes can be disrupted. Sanctions can freeze assets. Payment systems can be restricted. Nations are reassessing dependencies. Supply chains that once prioritized efficiency are being restructured for resilience. When blocks form and alliances harden, settlement systems come into question. If cross-border payments rely on a narrow set of financial rails, then those rails become strategic leverage points. Countries that fear exclusion begin seeking alternatives. This is where gold re-enters the picture. Not as nostalgia, but as neutral collateral. Gold carries no counterparty risk. It is not issued by a government. It cannot be sanctioned in the same way bank reserves can be frozen. For countries navigating a fragmented global system, holding physical gold is not a statement. It is insurance. It reduces reliance on any single currency block. Over the past several years, central banks and emerging economies have steadily increased their gold reserves. This trend has not been loud or dramatic. It has been consistent. These purchases are not protests against the existing order. They are hedges against uncertainty within it. When a nation accumulates gold, it is strengthening its balance sheet with an asset that sits outside digital payment networks. It gains optionality. In a world where trade flows can be rerouted and financial sanctions deployed, optionality has value. Supply constraints amplify this dynamic. If central banks and sovereign funds increase physical demand, while mine supply grows slowly, price sensitivity rises. Monetary stress meets physical limitation. The two reinforce each other. Silver carries its own strategic dimension. Beyond its monetary history, it is heavily used in industrial applications, including electronics and renewable energy technologies. As global infrastructure shifts toward electrification, industrial demand adds structural support that creates a hybrid demand profile. Part monetary hedge, part industrial input. When geopolitical blocks form and resource security becomes central policy, metals stop being passive commodities. They become instruments of strategic positioning. This reframes the recent price strength. It may not simply reflect fear of recession or expectations of rate cuts. It may reflect sovereign actors quietly adjusting reserves in anticipation of a more divided economic landscape. In that environment, gold's rise is not only about liquidity, stress, it is about control. Who controls resources, who controls settlement systems, and who holds assets outside political reach. And if physical control is shifting beneath the surface of global trade, then a larger question emerges. If nations are repositioning around real assets and neutral collateral, what does that ultimately mean for money itself? If nations are repositioning around real assets and neutral collateral, then the conversation inevitably turns to money itself. Modern fiat currencies are built on trust. They are not backed by gold reserves in the traditional sense. They are backed by productive capacity, tax systems, legal frameworks, and deep sovereign bond markets. As long as governments can issue debt at manageable cost and economies continue to grow, confidence holds. But when debt loads expand faster than productive output, strain begins to surface. Most developed economies now operate with historically high public debt relative to GDP. That alone is not an immediate crisis. What matters is the cost of servicing that debt. For years, low interest rates made large debt burdens manageable. Governments could refinance maturing bonds at modest yields. The rollover process was smooth. The environment has changed. As policy rates rose, sovereign yields followed. When existing bonds mature, they must be refinanced at current rates. If those rates are significantly higher, interest expenses rise quickly. This is the debt rollover problem. It does not appear all at once. It builds as larger portions of outstanding debt reset at higher costs. If yields continue climbing, governments face difficult arithmetic. Higher interest payments crowd out other spending or require increased borrowing. More borrowing at higher yields compounds the problem. Markets begin to question sustainability. At that point, central banks confront a trade-off. They can allow yields to rise, defending currency strength and anti-inflation credibility. Or they can intervene to stabilize bond markets, effectively managing yields to protect fiscal stability. Yield curve distortions often signal this tension. In recent cycles, parts of the yield curve have inverted sharply. Short-term rates exceeded long-term rates for extended periods. That inversion reflects tight policy combined with expectations of future easing, but it also pressures banks, which traditionally borrow short and lend long. When margins compress, lending slows, credit tightens. Currency depreciation cycles can emerge from this dynamic. If markets believe central banks will eventually prioritize debt sustainability over currency strength, the currency may weaken in anticipation. Not because of panic, but because of shifting expectations. It is important to distinguish between consumer price inflation and asset inflation. CPI measures the cost of goods and services. Asset inflation reflects the price of financial assets and real estate. Monetary easing can suppress yields and lift asset prices, even if CPI moderates. In that environment, purchasing power may erode through asset repricing rather than grocery bills alone. Gold functions differently in this matrix. It does not generate yield. It does not rely on corporate earnings. It acts as a hedge against monetary dilution. When currency supply expands faster than real economic output, each unit of currency represents a smaller claim on tangible assets. Gold's relative value adjusts. A move toward $5,500 gold, if it were ever to occur, would not simply represent enthusiasm for metals. It would imply a substantial repricing of currency relative to hard assets. It would suggest that markets have reassessed the long-term purchasing power of money itself. This is not a prediction, it is structural math. If debt grows faster than GDP for sustained periods, and if servicing that debt requires persistent intervention, then currency units gradually adjust to reflect that imbalance. The process can unfold slowly. It can be masked by productivity gains or capital inflows. But over time, imbalances express themselves in exchange rates, bond yields, or real asset prices. Gold rising in a high-debt, high-rate environment may therefore reflect more than near-term stress. It may signal that markets are recalibrating expectations about long-term currency stability. The hidden consequence is subtle. It is not collapse. It is gradual repricing. Savers holding cash may find that nominal balances remain stable while real purchasing power shifts. Investors may see asset values rise even as currency strength fluctuates, which leads to the most practical question of all. If currencies are being quietly repriced against real assets, what does that mean for households, savings, and everyday purchasing power? If currencies are being quietly repriced against real assets, the implications are not abstract. They reach into savings accounts, mortgage rates, small businesses, and retirement plans. Macro shifts eventually filter down to household balance sheets. This is where we slow down and apply simple cause and effect thinking. The first mental model is liquidity first. In periods of financial stress, access to cash matters more than the paper value of assets. When banks grow cautious, they tighten lending standards. Credit lines shrink. Loan approvals slow. Even profitable businesses can struggle if short-term funding becomes scarce. During these moments, liquidity is oxygen. Asset prices may fluctuate, but what determines resilience is the ability to meet obligations without forced selling. That applies to households with mortgages, companies with payroll, and investors with leverage. When liquidity tightens, optionality shrinks. The second mental model is currency versus asset. Nominal gains can be misleading. If a portfolio rises 10% while the purchasing power of the currency declines by a similar margin over time, the real gain is minimal. The distinction between numbers on a statement and real-world buying power becomes critical. Gold's rise fits into this framework. It does not automatically signal collapse. It can signal that market participants are hedging against potential currency dilution. In that sense, metals function less as speculation and more as insurance. The focus is not on dramatic price targets, but on preserving purchasing power across cycles. The third mental model is systemic versus cyclical risk. Cyclical stress is temporary. It reflects normal economic slowdowns. Central banks ease, credit flows return, and growth resumes. Systemic stress is different. It questions the structure itself, debt sustainability, banking resilience, currency stability. Determining which environment we are in requires observing credit conditions. When banks report tighter standards, it affects small business lending first. Expansion plans are delayed. Hiring slows. Housing markets feel pressure as mortgage rates remain elevated and loan approvals become more selective. This slowdown feeds back into markets. Slower growth can weigh on corporate earnings. Lower earnings can pressure equities. Declining asset values can reduce collateral quality, further tightening credit. The loop reinforces itself. Yet none of this implies inevitability. Financial systems are adaptive. Policymakers intervene. Markets adjust. The presence of stress does not guarantee breakdown. Gold rising within this context should be interpreted carefully. It does not mean that collapse is imminent. It may simply reflect prudent positioning in an environment where debt levels are high and policy flexibility is narrowing. It reflects uncertainty about how future trade-offs will be resolved. For households, the practical takeaway is awareness. Monitor liquidity. Understand exposure to variable rates. Recognize the difference between nominal performance and real purchasing power. Avoid overreacting to short-term volatility while staying alert to structural changes. Economic shifts rarely arrive with clear labels. They emerge gradually through tighter credit, shifting yields, and asset repricing. The key is maintaining perspective without complacency. Because if stress continues to build beneath the surface, the next question becomes unavoidable. What are the realistic paths forward from here? If stress continues to build beneath the surface, the future will not unfold in a single dramatic moment. It will branch. Markets are complex adaptive systems. Outcomes depend on feedback loops, policy choices, and confidence. Rather than predicting one path, it is more useful to outline structured scenarios. Scenario 1 is managed soft stabilization. In this path, central banks gradually ease policy as inflation pressures cool. Rate cuts are measured. Liquidity facilities remain available but are not heavily used. Bond markets stabilize without extreme intervention. Credit conditions remain tight but functional. Under this outcome, gold and silver may consolidate after their recent strength. They remain structurally higher than in the previous cycle, reflecting higher debt levels and geopolitical fragmentation, but they do not accelerate vertically. Equity markets adapt to slower growth. The system absorbs stress without fracture. This scenario requires balance. Policymakers must maintain credibility while preventing liquidity from seizing. It assumes no major external shock and no rapid loss of confidence in sovereign debt. Historically, soft landings are difficult but not impossible. The probability is neither dominant nor negligible. Scenario 2 is controlled currency. Here, debt burdens become increasingly difficult to manage at prevailing yields. Governments face rising rollover costs. To prevent destabilizing spikes in borrowing expenses, central banks introduce explicit or implicit yield caps. Balance sheets expand, even if official language emphasizes stability rather than easing. In this environment, bond volatility declines, but currency pressure builds. Investors begin to question long-term purchasing power. Real assets, including gold, reprice more aggressively as neutral anchors outside direct monetary control. A move toward significantly higher gold levels under this scenario would reflect currency adjustment rather than panic buying. It would signal that markets are recalibrating the value of money relative to scarce assets. Financial markets continue functioning, but the unit of account shifts gradually. This path is not chaotic. It is controlled, but it changes assumptions about long-term savings and asset allocation. It represents adaptation through monetary expansion rather than contraction. Scenario 3 is financial accident. In this case, a liquidity event emerges suddenly. It could originate in commercial real estate, leveraged credit, sovereign debt, or an unexpected geopolitical disruption. Funding markets tighten quickly. Counterparty risk becomes a headline. Central banks respond with rapid intervention to stabilize the system. Gold and silver could spike sharply in the early phase as trust temporarily fractures. Volatility would rise across asset classes. Over time, emergency liquidity measures would likely calm conditions, but not before repricing occurs. This scenario is lower probability, but higher impact. It reflects how nonlinear systems behave under stress. Small triggers can cascade if leverage and confidence are misaligned. Importantly, none of these paths are certain. Elements of each can overlap. Markets evolve. Policymakers learn from past crises. The feedback loops can amplify risk, but they can also dampen it. What remains consistent across scenarios is the role of liquidity and debt. High leverage limits, policy flexibility, currency stability depends on credible management of sovereign balance sheets. Gold's behavior suggests that markets are monitoring these variables closely. The key is to avoid binary thinking. The future is not collapse or perfection. It is adjustment. The pace and form of that adjustment will determine how far metals move and how currencies respond. Which brings us to the forward-looking question. If gold is already signaling stress at the margins, what happens when sovereign debt markets move from background concern to primary focus? What happens when bond yields, not stock indexes, dominate headlines? Because in the next phase, the question will not be whether metals are rising. It will be why the bond market finally blinked.